Hello and welcome to another episode of All Things Money. I'm your host Fatima Attarwala. My guest today is Abdul Rehman Warraich, Commissioner SECP, with somebody with a really strong background in financial services, even though he denies it. Hello, sir. Welcome to my show.
Thank you so much, Ms. Fatima. I'm really honored to be on your show. Thank you.
So, there's so much that I would like to talk to you about, and I sent you this really long list of questions as well. But I think one topic that I would like to really drill down upon is pensions. Now, pensions is this huge liability with the government right now. The pension bill with the government has gone over 1 trillion. So there's been a lot of reforms that the government has introduced. Maybe you could walk us through them.
Yes, thank you very much. I am also very passionate about reforming the pension system in our country. The governments have traditionally offered a defined benefit pension scheme to their employees. All the governments, whether the federal or the provincial. So this works in a way where the entire responsibility is on the employer. The employer has to decide how to set aside funds to meet the future pension obligations. The employer has to take care of the investments, and the future guarantees of payment are also made by the employer. So the governments tried to do everything by themselves, and in hindsight now it seems that this was a major mistake that the governments were making. You might have observed that defined benefit pension schemes have become almost extinct in the private sector. We all know that private sector is more efficient and more they have better technical expertise compared with the public sector. So they realized 20, 30 years ago that these promises were easier to make but very difficult to fulfill. So the private sector switched from defined benefit to defined contribution pension schemes many years ago, all over the world. But the governments were slow to realize and to adapt. And finally, when the governments in Pakistan saw that the pension schemes have matured and now the employees are retiring in very large numbers, and the government never had the expertise or the resources or the financial discipline to do all the things that were needed to manage those schemes properly. So now when they saw that the pension expense was getting out of control, then they sat on the table and tried to engage with different consultants and advisors and try to take a stock of the situation. And then thankfully, starting with the government of KP and followed by Punjab and Sindh and federal government and Balochistan also, all the governments seemed to have concluded that contributory pension schemes are the way forward. And I am personally a big proponent of contributory pension systems because I think that no employer, whether a private entity or the government, has the resources and has the expertise to manage the entire pension scheme by themselves. You can be successful at managing these schemes only when you collaborate with all the relevant institutions and experts in the private sector. So I am now happy that the governments have embraced the contributory pension system. Now, this will make the entire private sector a major stakeholder in the scheme. Now, previously, the government was itself the sponsor of the pension scheme. It was the fund manager, it was the custodian, it was itself trying to become the auditor. It was trying to become the insurer also. No government can do everything on its own. So in the contributory scheme, it's great that the governments have decided to adopt the contributory pension system, which is very transparent and which is regulated by an independent regulator, like Securities and Exchange Commission. So now the pensions money, the contributions will be made every month along with the payments of salaries to the employees. And expert professional fund manager will invest that money. Guarantees, if any, required by the pensioners would be designed and offered by insurance companies. The custody of those funds would be with expert custodians like the Central Depository Company, and if there could be other banks, getting licenses to act as professional custodians. The audits of these schemes will be carried out by independent auditors in the private sector. And many of the decisions will be made by the employees or the beneficiaries of the pension schemes themselves. So they will decide how the investments will be made. There are two broad categories of investments. There could be fixed income investments, which are less risky and whose returns are all a bit lower but more predictable. And then there are equity or stock market investments where the risks are high, but over the longer periods you can make more profits also. So the employees will be able to decide what portion of their contributions, pension contributions, is invested into fixed income avenues and what portion goes into stock market, subject to some risk limits imposed by the employers, of course. But there will be a lot of flexibility for the employees. So I think the best thing that has happened as a result of this reform is that the governments have decided to set a standard for the private sector employers as well. Although the private sector had already switched to contributory system, but they were doing it mostly through provident funds. Mainly, the main instrument has been provident funds lately, which are managed in-house, which are not very transparent, not as well regulated as the contributory pension system overseen by the SECP. So hopefully you will see more and more employers in both the public and private sectors which will embrace these schemes. And the best part is that the entire private sector has now become a stakeholder in these schemes. Everybody now wants these schemes to be successful. The government will have to discipline itself and make the pension contributions regularly. The employees will have access to their online pension accounts 24/7. Any employee can log into their pension account and see how much has been contributed and how much profit has been generated as a result of those investments. The monies will be invested by professional fund managers. The guarantees will be offered by professional insurance companies, and there will be auditors and there will be custodians. So a whole ecosystem will be nurtured and will hopefully flourish. So I think that is the best part, that something that the government was trying to do alone now will be done in collaboration. And as a result, we can talk about that later in this discussion. The economy will benefit, the employees will have more control and more flexibility, more jobs will be created, and particularly the high skill sectors like accounting and auditing and financial analysis and investing and insurance and custodial services. These are high skill professions. So these professions will also hopefully grow faster. So there is a win-win situation for everyone. The governments get to manage these schemes in collaboration with others, and other stakeholders also do their part, and as a result everybody benefits. So I'm really excited, and all credit to all the governments, in particular the government of KP, which was the first one to make that decision. And they were led by their then finance minister, Mr. Taimur Jhagra. He had worked abroad and he understood the value of the contributory pension systems. And the entire finance ministry within the KP stood right behind him. And I was really impressed by by their decisiveness and by their keenness to undertake pension reform. And then, of course, all credit to other provinces, their leaders, and to the federal government as well. The current leadership in the finance ministry, in the federal government, they have been very clear and decisive. The current secretary, Mr. Imdadullah Bosal, made sure that the government decides to move to a contributory pension scheme, and instead of trying to manage everything by itself in-house, the government decided to opt for a transparent and well-regulated pension system that already existed for many years for the private sector, that was overseen by SEC. And our finance ministers in recent years, Mr. Ishaq Dar, Dr. Shamshad Akhtar, and Mr. Muhammad Aurangzeb, they were also very clear that the private sector must be a partner with the government, and we have to encourage specialists to play their role. We have to let the professional managers, fund managers and insurers and custodians and auditors to play their role. We have to give more powers and more flexibility to the employees. So this clarity has been there in recent years, that we have to do it in partnership with the private sector. The government cannot and should not try to do everything by itself. And in Punjab, of course, this decision was made under the leadership of their current finance secretary, Mr. Mujahid Sherdil, and of course, the political leaders and the chief minister. So I'm really happy that all the governments have realized this, and I believe that they're moving in the right direction. And the private sector, which was already convinced that contributory schemes are the way forward, but they were still trying to do it in-house through provident funds and all that. I think that the governments have now set a direction for the private sector as well. And I'm very confident that within a few years, many more employers in the private sector will also follow suit, and they will also adopt this contributory pension system. I'm sorry, I probably went on for too long. This subject is very close to my heart.
It's very good that we have experts like you explaining it. Now, as you said, we have moved from direct benefits to direct contributions, and that fiscal discipline was very necessary because of everything that has been happening in the country. The government does not have the money. None of the governments have the money to pay out such high amounts of pensions. And under the IMF program, we cannot continue to print money and continue to rack up our liabilities. But from the employee's point of view, I mean, in the long run, in the next 20 years, this would benefit them. But with everything that's happening in the country, the high tax rates, the high inflation, the lower purchasing power, the direct contribution of, say, 10% might not be something that an employee will happily make. It's my understanding that an employee makes 10% contribution to the pension fund, and then the government pays 12%. So the overall is 22%. So again, great for him 20 years down the road. But if he needs to pay the electricity bill today, the school bills today, he might not see this in the same light.
I tell you, I think that you will see a higher growth in salaries going forward. I think it is already happening.
The government sector or the private sector? Because I belong to the private sector, no growth happening.
Yeah, in the public sector, definitely. Maybe for the time being, the economic growth is slow and the salary increases are probably less than what they should be. But when the employer knows that their obligations are limited to the contributions they are going to make, they are much more inclined to pay better salaries. The defined benefit schemes discourage the employers from paying better salaries because higher salaries come with huge future promises of pension payments. So I think this will unlock the ability of the employers to pay their employees well. And I think then it will not be painful for the employees to contribute a little bit into their pension accounts themselves, and of course, some contribution coming from the employers. So my hope is, and I'm quite confident that this will happen, that the ability of the employers to pay better salaries to their employees will improve. Um,
We are
and the other
all
thing is
hoping
that
for
we
that, I
need to
think.
spread this message through programs like yours. We need to tell the employers
To pay more to the employees.
to their
Yes.
employees, because the pension schemes are now contributory. They don't have an obligation for lifetime payments to the employees. Many of the decisions will now be made by the employees themselves. So the employers don't have to plan for multiple generations to meet those pension promises. They can set a decent contribution rate, pay a decent salary, make sure that the pension account, the pension contributions are transferred to the pension accounts on a regular basis, and try to provide more education to the employees so that they can manage their pension accounts better. And one more thing, one major constraint, or I would say, in some ways, a disadvantage of working in the public sector has been that you do not become entitled to your pension unless you have served the government for 25 years or more. I have also been a civil servant. I left after 10 years of service, and I had nothing in my pension account. My pension benefit was not portable because I did not serve for 25 years. So I got nothing in pension benefits. I think in the modern world, which is much more dynamic, where employees want to have more options and the flexibility to move to other employers and other jobs if they think they can do better, they should not be held back by the necessity or the compulsion to serve their current employer for a certain number of years before they become entitled to something. So the beauty of these contributory pension schemes is that the pension account right from day one is in the employee's own name. All the pension contributions that go into that account and the profits that are earned belong to the employee. So even if you decide to switch to another employer or start your own business after a few years, the pension account stays with you. All the savings that you have accumulated stay with you.
But can you withdraw money? Say there's a family emergency, you need 20 lakhs immediately, you have that in your pension account. Can you withdraw it before 20 years have passed or till the retirement age?
I would say that this contributory pension system comes in two ways. One is the voluntary part, where my employer doesn't require me to have a pension account, but I go to a pension fund manager which is registered with the SECP. I open a pension account and voluntarily build savings in that account. I can withdraw that money if I want to. But I forgot to tell you that when you make contributions into this pension account, you get a tax benefit. Your income tax liability is reduced. So if you decide to withdraw money before your retirement, you will have to return the tax benefit that you took. So I personally think...
Could you quantify the tax benefit? How much?
Yes. So say if my annual salary is say 3 million, and my average tax rate is say 20%, so I pay 600,000 in taxes. So whatever I will contribute into this pension fund, we can calculate it as a percentage of my taxable salary. So if I contribute 10% of my taxable salary in the pension fund, 10% of my tax will be reduced. So out of the 3 million worth of taxable salary, if I contribute 300,000 in a year into the pension fund, my tax liability of 600,000 will also be reduced by 10%. So I'll be paying 60,000 less in taxes. So I get to save 20% of what I put in my pension fund. I get to save 20% of that in my taxes. But there is a maximum limit to the contributions which are eligible for tax benefits. So you can go up to 20% of your taxable salary. As long as you contribute up to 20% of your salary in a regulated pension fund, you can save up to 20% of your taxes. But if you contribute more, the additional amount will not be eligible for the tax credit.
So the tax credit, the maximum amount is 20%.
20% of your taxable salary,
20%.
which means 20% of your tax liability can be reduced if you have enough discipline to, save and contribute 20% of your salary into the pension fund. As far as the short-term emergencies and needs are concerned, I would strongly recommend to your viewers and to our fellow citizens in our country that they should have some savings in their bank accounts and their mutual fund accounts. I am, by the way, a big proponent of mutual funds. Pension funds are a specialized form of mutual fund where you save for your retirement and for your old age. But there are regular mutual funds where you can put money and withdraw at any time. So there is no compulsion to keep the money invested for a certain period of time. So they are very similar to bank accounts, but they offer you more options for investment. In a bank, you can only expect a fixed sort of a very predictable return on your savings accounts. But in case of mutual funds, you can have a money market account, which is similar to a savings bank account. But you can have other avenues. There could be income funds which invest in long-term bonds and which can pay a higher return to you. They invest in long-term bonds issued by the government or by the private sector. And then there are equity funds which would invest in listed stocks in the stock market. And if you invest there and if you can hold on to the investment for longer periods, you can make a lot more. So I would strongly recommend to your viewers that they should have mutual fund accounts along with their bank accounts. And for their emergency needs, they should have an emergency reserve, which is some money lying either in a savings bank account or in a money market mutual fund. I would recommend money market mutual fund should take a priority because we use our bank accounts too often and there is always a risk that we will end up spending that money, which was meant to be an emergency reserve. So the money that you want to set aside for a rainy day, initially it should go into a money market fund, and if you are able to build more savings, then some of it should go into an equity fund or an income fund, which are relatively more risky, but which offer higher returns also. So for emergency needs, you build an emergency reserve through a bank account or through a combination of mutual funds. For your old age and for your retirement, you open a pension account and you make contributions into that. You would be extremely lucky if your employer has a policy, which inshallah our governments are going to have in future, and many more private employers are going to have in future. So you make those contributions, save money in taxes, and another good thing about these pension funds is that the profits are also tax-free until your retirement. Whatever the fund earns by investing your contributions remains exempted from income tax until your retirement. And even after retirement, a portion is still, you can take it out tax-free, and there is a portion which will be taxed. So I personally think that it is an amazing product. It empowers the employees, provides them more control. It is much more transparent. You have 24/7 access to your pension account. It allows the private sector professionals and experts to provide all the services that you need depending upon your needs. So it has a range of benefits. You get to save on your taxes also. So it has a range of benefits. It is difficult for any other pension scheme to match or exceed all the benefits which are currently offered by this contributory pension system that is regulated by SECP.
So if you have a blueprint for an average investor, we have mutual funds for a saving, a rainy day kind of fund.
Yeah.
So which are fairly liquid, so that if you need it, you can sell it off.
And also to build wealth for your needs. If you want to have a world tour 5 or 6 years from now, if you want to go for Hajj, after a few years, if you want to save for your children's marriage or higher education, mutual funds can be a great vehicle. You put a portion in the money market and income funds and some portion in equity funds, and the income funds will provide a stable income. Equity will hopefully provide growth as the GDP grows and businesses become more profitable. So the stock funds will multiply in value. So for your emergency reserve, money market funds. For your medium term needs, you have a mix of income funds and equity funds. And for your post-retirement needs,
You have
have
voluntary
pension
pension
funds.
schemes,
Yeah.
So I think this is a great diversified portfolio that looks at the equity market, which is having a rally after rally with everything that is happening. It looks at what your needs are going to be 20 years from now, and it gives you tax credits. So even your current spending income, you get a little bit more of it. But I think most people in Pakistan, when they think, okay, I need to save, they go buy dollars or they go buy gold. These are very, for the average investor, middle income group, I think that is the most common form, especially right now when gold had this tremendous rally. In fact, I had people telling me that women were selling their jewelry to buy gold bars, which makes no sense because the amount of gold is the same. So what advice would you give to them? Because for them, it's so easy. You can go to a jeweler, buy gold. You can go to the money exchange and buy dollars and you can keep it. So why should they go for the voluntary pension scheme or the mutual funds, which has paperwork and regulatory requirements and is a bit more arduous than the other two options?
That's a very interesting question. I'll give you my views and my
And perhaps a returns
thought
comparison?
process. I would always invest in avenues where there is potential and scope for regular income. So I would always want to give my money either to the government or to a business, because both are engaged in productive economic activities. The government spends money so that the economy grows, so that many services that the private sector does not provide are provided in the economy. And in return, the government is willing to pay a profit to me if I decide to lend money to the government. So I think it's a great combination. Your government wants to do good for the society, and if it needs money, you go and lend some money to the government. So that seems like a very meaningful investment to me. And similarly, if you are either lending or making an equity investment in a business, you're again contributing to the economy. The business is going to provide many goods or services to the economy. They are going to generate employment. They are going to raise the skill levels in the society, and hopefully, and in practice, of course, the government and the businesses also take care of their employees also. So I would really want my money either to be used by the government to do good for the economy and for the society, or by the business to invest in to utilize in some productive economic activity. Investing in an asset which I'm going to passively hold, buying a plot of land and holding it for 20 years in the hope that it will multiply in value, or buying gold bars and hoping that they will increase in value after so and so years, or holding dollars, hoping that there will be some major currency devaluation. In my portfolio, it would have a very small place. I would not probably invest more than 10 or 15% of my portfolio in such assets where I have to hold them passively in the hope that someday they will multiply in value. I would rather want to become a part of the real economy, lend to the government, or lend or invest in actual real businesses which are undertaking economic activity. So one angle is purely motivational. I feel more motivated when I participate in the economy. And the second is the prospect of regular income. When you lend to the government or a business, they of course promise to pay you a certain profit on regular intervals. If you make an equity investment in a business, of course, you hope that since they are into different kinds of productive economic activities, hopefully their profits will grow and you will also benefit. Your investment's value will also grow. So I think the prospects of growing your wealth are much better when you invest in businesses or lend or invest for real economic activities. Holding the assets passively, I think it's more of a speculative activity. Holding dollars, hoping that they will increase in value, that's more of speculation. And the same with gold. They may have some benefits also, because sometimes if you feel that there could be an economic crisis and these assets will increase in value all of a sudden, so maybe you can have some allocation to these. But I would strongly recommend to the women in our society to have bank accounts and mutual fund accounts. They should hold gold either in the form of ornaments or gold bars if they want to, but they must have a portion of their savings kept in a bank account and in a money market fund as an emergency reserve, and some of it invested in income funds and equity funds for growth. So I think it's more a matter of awareness and education also. Traditionally, holding plots of land and dollars and gold, people are more familiar with these avenues. We don't really appreciate and understand how much we can grow our wealth through regular savings and investments in regular businesses or by lending to the government. I think these avenues are underappreciated and people don't fully understand, and I think it's the duty of professionals like you and me to spread this message that these avenues are also very useful, and I would actually strongly recommend that majority of our savings should be invested in these avenues where the growth prospects are much more predictable and much higher over the longer run, and where the contribution to the actual real economy is much more meaningful. The speculative investments may have a place in our portfolios, but it should be a small proportion.
I think your advice is very solid, very sound. It's for risk-averse individuals who want to see their wealth gradually grow over the years. Now, Pakistan has among the highest adoption rates for crypto. We are a get-rich-quick economy. So I think when we buy dollars or gold, or especially crypto, meme coins, I think the idea is how much money can I make from this much amount in the next week, the next day. In an economy like that, when you have so many people chasing after money, I mean, I just did a story on crypto scams, and I think the most horrifying part of the story is in 24 hours, I had half a dozen cases like this. Because it's so common, because people want to make money so fast, and also because the economic environment is such that everybody is feeling the pinch really, really hard. So when people have such high risk appetites in Pakistan and want to make money fast rather than grow them over decades, what advice would you give them?
Honestly, I don't think we have a high risk appetite. I think mostly we do want to get rich quick. I think it has become very common around the world for people to want to get rich quick, and any speculative investment would catch their attention. I personally think it's very unfortunate that we don't try to fully understand the pros and cons of the financial decisions we are making. We're just obsessed by looking at somebody else who made a speculative investment and made a lot out of it, and we just want to follow that. We are not really interested in properly understanding whether it is the right thing to do for us. I think it's a bit unfortunate. I think you're doing a great service to this society by bringing these issues and topics under discussion. To me, cryptocurrencies are privately issued currencies which for some reason have started to compete with the official currencies in some ways. Most of their attraction is for uh, the informal, those who operate in the informal economy and probably who want to avoid proper scrutiny and documentation. Some people may genuinely believe that these cryptocurrencies are set to increase in value. I personally don't think that investing in cryptos or gold or in open plots of land contributes meaningfully to the real economy. So I see cryptocurrencies as assets which have no intrinsic value. These are just currencies, and if you expect them to increase in value, you are basically speculating. So cryptos belong to the set of the speculative assets, as I referred to earlier.
And what
Even if you
percentage
want to
of your
invest in them, I personally think not more than 20% should go
Of your
into
portfolio.
speculative assets. And of course, a much smaller proportion for cryptos because the other assets make much more sense. Even if I had to passively hold on to an asset, it might well be a real asset like a plot of land or gold rather than an imaginary
absolutely,
asset
yeah.
like a crypto. But if there are people who do believe that they will increase in value, they may do that. But I would strongly recommend that we should make investments which contribute into the real economy, which enable real economic activity. And that can only be done by investing in businesses and by lending to the government, because that is where the real economic activity is happening. And that's where the long-term profits are. I think these investments in speculative assets are usually motivated by either the desire to get rich quick or to avoid taxes in certain cases. But I think in the long run, if you participate and invest in real economic activity, in real businesses, the whole society is much better off and you will also be much better off. So I would much rather want to get rich slowly and steadily rather than take an excessive risk into some and put all my savings into some speculative assets. I mean, that may pay off, but I would not like to go that route. I would rather like to do something that I understand, which motivates me, where I know where my money is going and what benefits the society is getting, where returns are much more predictable. So that's what my approach would be towards investing.
So
our
we've talked
savings.
about equities and mutual funds and voluntary pension schemes. How about we bring in insurance plans in the mix? You know, in the old days, my father's time, you would have an insurance plan that over 20 years, 25 years would give very high returns. So given the strings attached, the fees, the charges, all the hidden charges, if you were to compare the voluntary pension schemes to insurance to, say, fixed income mutual funds, how would you rate the three?
I believe in pure insurance, just like you insure your car or your house. You pay a premium, and if God forbid you face a major loss of your asset, you are compensated by the insurance company. So the premiums that people are paying go to only those who face those losses. I think the real purpose of insurance is to manage the major financial risks that you may confront in your life.
So to use insurance
So
as an
I'm a big
investment vehicle is not the best of idea.
To me, it is not. I think in case of life insurance, it has become very common. The predominant product that we see in the insurance industry is to package a savings and investment plan with insurance. But in that process, the risk cover or the insurance cover that you are getting gets diluted. For instance, if I pay 100,000 in an insurance premium in a year, and if it was a pure term insurance, just like I insure a car or a house, term insurance premiums are usually in the range of 1 to 2% of the benefit. So your benefit is typically 50 to 100 times if you face that loss. So if I was paying 100,000 a year in a pure insurance premium for a life insurance policy, in case something happens to me, God forbid, my family would expect to get 50 to 100 times of that amount. And that can provide some security to them if something, God forbid, happens to me. But when I pay the same premium for a policy where pure insurance is packaged with a savings and investment plan, so probably out of that 100,000, only 10,000 goes into pure insurance and 90,000 goes into a savings and investment plan. So what we have basically sold is 80 or 90% a savings and investment plan, and only 10% has been sold as pure insurance. I think that the citizens should be mindful of that, what they are actually buying. Even if you want to do business with an insurance company, you can ask for these products separately. You should ask for a pure term insurance, and you should have a clear idea of what kind of insurance benefit would you like your family to have in case something, God forbid, happens to you and you become incapable of providing for your family, and you buy a pure insurance. Because if by paying a premium of 100,000 a year, I have purchased an insurance cover of only 1.5 or 2 million for my family, then in case of an emergency, that's not going to be of much help. So the insurance benefit should typically range from 80 to 100 times of what you are paying as an annual premium. If you are entering into a policy which provides much lower benefit than that, then you are diluting your insurance benefit. Savings and investment schemes have a value in their own right, as we talked. Usually mutual funds are the best way to do that, but insurance companies also have developed expertise, and they also offer schemes which are very similar to mutual funds, and you can invest and save for your old age. But I think the people, our fellow citizens, should have clarity, and it's our responsibility also to educate them that they should be able to separate pure insurance from a savings and investment scheme. And the pure insurance should be very clearly designed, and the insurance benefit that you're going to get in case of a loss or emergency should be in accordance with what you actually need. So I think that the insurance policies have become tricky because of this packaging of saving and investment with an insurance cover, and individuals should be more mindful of that. And I do recommend that every one of us must have a pure life insurance, which in case of a family emergency provides at least 80 to 100 times or maybe more. If you purchase such insurance at a younger age, the multiples can be much higher because you're supposed to be healthier, and your risk of dying or becoming disabled is very low. So I do think that within the life insurance industry, there is a great need for a pure term insurance. And we, people like you and me, should try to educate the people and the citizens of our country to be mindful of that.
So if I were to sum up our discussion about voluntary pension schemes and everything, an ideal portfolio would have only about 20% in speculative assets like gold and dollars. A smaller percentage, 20% would be in something like crypto, which has no intrinsic value. A long-term saving scheme would be the best, would be probably a voluntary pension scheme. For a rainy day account, a mutual fund, especially an equity mutual fund or a fixed income mutual fund, that would work. And insurance should be treated like insurance rather than a saving and investment scheme. So that would serve its purpose better. Great. I think that's fantastic advice.
Yeah, that was a great summary of what we have discussed today.
And I think that will be very helpful for increasing financial literacy as well. Thank you so much for coming to my show, sir. I think this was a very educational discussion.
Thanks to you for providing this opportunity.
Thank you.